Before I start this week's episode, Andy, I just want to say a quick thank you to our sponsors, Fidelity International. And whether you're just starting out or an experienced investor, Fidelity offers a range of investment options with plenty of information, tools and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. And do remember, the value of your investments can go down as well as up, so you may get back less than you invest.
Hello and welcome to episode 411 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, it is great to have you back again. I missed you last week.
Well, I missed you too, Andy, and I'm full of energy and buzzing to be back on the podcast. I did listen to the show in my absence, which was a very good show. I mean, I wasn't on the podcast last week, yet you did hear recordings of me and stuff that we've done in the background in terms of mortgages and stuff. So I feel a million times better. Actually, one of the things I put on social media was about the side effects or potential side effects you get from antibiotics, which struck a chord, it seems, with our audience, because lots of people got in touch, not just to wish me well, but actually to talk about the crazy side effects of having a black hairy tongue, which was the bizarre side effect you can get on a certain antibiotic. So thank you to everybody who kept me amused while I was in my sick bed via Instagram. So I am back this week and we've got the usual three pieces on the show. But before we do that, Andy, you're going to read out a couple of podcast reviews. So thank you to people who are sending in the reviews. Please make sure you keep doing that because it is incredibly motivating. I do regularly check to see if we get new reviews, and you also can get a Money to Masses mug for doing so. So Andy, I'll hand over to you to go through two of the most recent podcast reviews. The others we will get to in the coming weeks.
That's right. So the first review is from Cold E.T. Biker, and they said, I realise this podcast is free, but nevertheless, it represents amazing value in terms of the return for your time. I started with recent episodes and I'm now so hooked. I'm working my way back through the whole catalogue and have made it to 85 in under a week. Absolutely love it. Thanks. Wow, 85 episodes in under a week.
Well, that's impressive, because even if you say the average episode is 30 minutes, that means they've spent over 40 hours listening, which in a week, they can do it twice speed, but wow, that is some dedication.
Pretty impressive. And the last one we'll read out this week is from AntManron98, and they've said, I always thought growing up the only way to grow my money was to put it into a savings account. Investments were for people with large sums and I could possibly lose it all. Thanks to the great team at Money to the Masses, I've found the confidence to invest in my family's future with a LISA, JISA and stocks and shares ISA. I mean, that's fantastic that they're taking all that advice on. They've helped me realise that £50 a month can add up over time and hopefully help my children be the first homeowner in our family. Thank you. That particularly struck a chord with me. I think that is our teachings all summed up in a really nice review there, where they're actually passing not only their wisdom but their wealth on to their family and children. I think that's brilliant.
And it's almost a version of that teaching a person to fish rather than giving them a fish. And I like that, because if you can inspire people to make changes and therefore they can inspire their children and it can be life changing. I mean, that to me is why I started doing any of this on Money to the Masses. So it is great to receive that kind of feedback and hear that people are on their journey. We may be part of it for a while or continually, or they might go off onto other mediums or avenues for finding out about money. That is great. As long as we can spark and start that journey and be part of it at some point, that is fantastic. So if you are either of those people, do write in damien@moneytothemasses.com, then you can claim a free Money to the Masses mug. Now, talking about growing wealth, I'm going to throw out there, the last episode of our Grow It series will be out on Tuesday, so don't forget to listen out for that. You can find it in this podcast feed, or you can actually go and watch it on YouTube. YouTube is obviously a great way to consume it because there are things that are displayed on screen, but it does work as a podcast as well. So that is an evergreen series that is aimed at encouraging people and teaching them, educating about growing their wealth. So I'm going to move on, Andy, and tell you what's going to be on this week's podcast. Now, three pieces. First one, money market funds. They've been in the news for various reasons in the last couple of weeks, and I'm going to explain what they are and the drawbacks and some of the attractions of them, but particularly focusing on the drawback. So just to give you a quick insight, a money market fund is basically like a cash fund you might get within your stocks and shares ISA or your pension. I'm then going to talk about the banking crisis, but how to carry out research on funds, be they unit trusts, investment trusts and ETFs, to find those that are most exposed to a banking crisis if it continues or it escalates, because there is an element of calm at the moment in markets, but there's nothing to say that it won't escalate in the future. And the final piece we're going to do is around mortgages, but particularly mortgages to do with maternity. So if you are on maternity leave, going to go on maternity leave, or you are planning on having a baby, you may be worried about what your options are when it comes to remortgaging. So there are millions of people who are going to have to remortgage this year and into next year. And of course, you might be sitting there thinking, my income's going to drop. Does that mean I'm now going to be stuck on my deal and have to pay the really high standard variable rate and I won't be able to afford it? I've got some good news for you in a quick piece at the end of the podcast.
Okay, so let's start with the piece on money market funds. What have we got?
So money market funds are what people would probably think of as cash funds. So you might see something out there. I'll give you an example. There's one called the Aberdeen Sterling Money Market Fund, Fidelity Cash or BlackRock Cash, and they will be funds that you could actually put your money in it. You're thinking, well, this is effectively cash. I'm going to get cash-like returns in this particular fund. Within, it could be your stocks and shares ISA, or it could be within your pension, maybe a SIP. Now, before I get on to what they are, money market funds have gained a lot of press of late, particularly in the US. Now, in America, the amount of money that has been flowing into these funds has swelled by $4.6 billion in the last year. And half of that has come since the start of 2023, making a total of $5.4 trillion being in these cash funds. And when I say cash funds, you can't see me, but I'm doing that annoying inverted comma thing with your fingers. So that's according to MarketWatch. Now, in the UK, if you take 10 of these funds, these are the ones, if you go and do some research, you'll come across quite quickly. They are in the sectors called like short-term money market funds or standard money market funds. And if you take this 10 of them, that will come up straight away if you do some research. Some of them I've already named. Now, if you look at the size of those, there's £10 billion in just those 10. So that's on average £1 billion in each of those funds. That's a lot of money. Now, in America, the reason why it was particularly interesting is because there's been massive inflows, partly because of the banking crisis. So when we saw SVB start to struggle, and if you want to know more about that, you can go back 2 podcast episodes where I did a whole piece explaining what's going on in the banking sector. What happened is people started pulling money out of banks and they wanted to put it somewhere, and they started to put it into these money market funds so they could get an effective return on their cash. Now, one thing to bear in mind that in America, they have regional banks, and a lot of these banks were offering accounts that were uncompetitive when the Federal Reserve started raising interest rates. So as interest rates in the economy start to go up, then the return that people expect on cash increases. So if you think in the UK, you will see stories saying that the rates on savings accounts have been going up, and that's because of the fact that the Bank of England base rate has been increasing. So the rate that you can expect from savings account goes up as well, because obviously the banks have got to remain competitive. The thing is, in a world where we were getting 2/5 of nothing on savings accounts, people didn't really pay much attention because cash was seen as a bit of a drag on a portfolio because you didn't get a return. Now we're in a world where in the UK the base rate is 4.25%, but of course we're seeing similar aggressive rate hikes in the US. You can then start getting a decent return on cash. You can find 4% in the UK very easily without doing much research, to be honest, and you could get as much as 5% at the back end of last year. And that is attractive. And suddenly, rather than people just ignoring the money that they had in cash and what return they got on it, they start thinking, well, hold on a second, should be getting a way better return. When you get to that 4-5% level, something happens, because obviously that's a decent level of interest. So people in America have been moving their money out of banks. There's been a trend that's been unfolding into these money market funds. And this has been almost like a slow avalanche that's been going on. And of course, what happened with the banking crisis that happened in the last few weeks, it accelerated that. And so people are moving very quickly because they've got technology. They can just move the money out of one of these banks and put it into one of these money market funds and get a better return. So that has caused, obviously, problems. Now, in the UK, it's a similar thing. Obviously, if you've got money now that's in a pension, so you could have a SIP or it could be a stocks and shares ISA, people are thinking, well, cash does offer a decent return now, given the risks that are out there. So people are looking at these money market funds. So they look at these funds that are titled cash and think, well, actually, I could get a good return on there. Now, this is where you have to understand what a money market fund is. Now, a money market fund could be typically a mutual fund, or in the UK, you'll see it known as a unit trust or an OIC. And they actually tend to invest their money in short-term cash deposits or high-quality bonds, which can include government debt or money market instruments. And money market funds are very useful in an economy because they actually provide funding for governments, local authorities, charities, pension funds. And of course, for consumers, they can give you a return on cash. So they serve a purpose from an economic standpoint, and for institutions. For retail investors, so like us, they probably don't deliver quite what people are thinking because they aren't cash. That's the first thing. Your money is not going into a bank account. It is an investment. And the problem is that there is a potential you can get back less than what you put in. Now, the risks are low. That is true. But because your money's not going into a bank account, then it's going into technically some form of investment. The FCA even confirmed this if you go and look around risk warnings to do with money market funds. They're very keen to highlight to people that money market funds are riskier than cash. And the problem is they do offer same-day redemptions, but they can have less liquid assets within them, which means that if lots of people decide to pull their money out of these money market funds, then they can't sell all those assets immediately, and it can cause a liquidity issue. Now, you do get paid interest technically by a money market fund, but it doesn't really work in the same way as a cash account. It's variable and it's not guaranteed. And what happens is it resembles something called SONIA, which is the Sterling Overnight Index Average Rate, which in itself is closely tied to the Bank of England base rate. So if you think about cash funds or these money market funds, they are giving you a return that is probably fairly closely linked to the Bank of England base rate, which is why, therefore, they are attractive. Now, if you go back and listen to episode 406, Andy did a piece of research that was focused on the interest rates you could get from platforms. So that isn't cash funds. That is if you held cash within the platform, what interest rate you would get. And of course, a lot of them pay pretty poor rates of interest even today. Now, of course, that makes money market funds attractive because you're getting something that is going to be more in line with what's going on with the base rate. Now, while that is true and that can be a positive and they can be a short-term park for your cash, and they technically are lower risk than things like bonds, negatives of them are, firstly, you're charged an annual management charge for being in a fund that is cash-like. And of course, you're still going to have to pay your platform fee. But there are counterparty risks and credit risks in there because there are, within those money market funds, financial instruments. Those financial instruments are effectively going to be delivered, backed essentially, by third parties, and if something goes wrong with those, then there's a risk to your capital, and it means that you can get back less money than you put in. Now, if you go back to 2008, so the financial crisis, there was a number of money market funds where their value fell, so people were getting back less than they put in, and there was a big case in the UK. Standard Life had an issue. Now, since the 2008 financial crisis, things have been put in place to try and limit that kind of thing happening again. But technically, it still can. Interestingly, the money is not covered under the Financial Services Compensation Scheme if you put it in a money market fund in the same way as a cash account. So if you just had a bank account, it doesn't work in the same way. You're not covered like that. What you're covered under is as an investment. So you still can get that £85,000 protection if it's an investment. But again, that protection is going to be based on per institution. So if you hold funds with that company elsewhere, then let's say something went wrong, then you are only going to be covered up to £85,000 with that one institution. Let's say it was Fidelity, for example. If you had Fidelity funds and you had a Fidelity cash fund, or could be an Invesco cash fund. And so you have to bear that in mind when you're investing in them. Of course, money market funds, you do technically still have to pay income tax on them. If it's within, obviously, a tax-free wrapper like a SIP or a stocks and shares ISA, you don't. And you technically have to pay capital gains tax on them. But the message of this part of the podcast is that money market funds are starting to get a lot of interest. I don't mean the pun there, but a lot of interest because of what's been going on in the banking crisis in America, and then that came to the UK and Europe. We're getting lots of money flowing into those money market funds. That's even occurring in the UK, perhaps where our money market fund universe isn't as big and people don't use them in the same way, but money's going in there. Be careful is all I'm saying. Be aware that there are risks in doing so. You can get back less than you pay in, and of course you've got to realize it is not cash. The point is that I would be loathed to use a cash fund because I remember 2008, and I know the world is meant to have changed, but in a world where there is potential for crises and a financial crisis maybe in the future, then always be aware of what protections you have. And although there is these outside risks that most people dismiss, it's always in those instances like 2008 where they come to the fore. So just be careful with money market funds. Understand what they are. You look at the fund fact sheets and you understand the risk you are taking. And one thing I did want to add, because obviously platforms now are often paying some decent rates on cash you hold just on the platform, not in money market funds. Now, there was a really good question in our Facebook group this week about protection having £85,000 with a particular platform. Now, I'm going to link to it because I think it's brilliantly explained by Sean Towers, who's a member of the group, who explains about how protection works with platforms. We've covered it before on the podcast, but he has done it very well. So it talks about funds, it talks about cash held. And one thing I just want to point out, that if you do have cash balances on a platform, you need to make sure that you understand where those cash balances are held, because the FSCS protection for those is again per institution. So if you have different platforms that hold cash as well, they could be holding cash at the same institutions as the other platforms you have. So basically you need to double check where all of your cash is held and whether it comes under that £85,000 limit. Now, one thing I will say, that a number of platforms, I've looked into it, they may spread the cash balances across a number of big banks, and they may say, for example, they will only expose up to 35% of client money to any bank at any given time. So you won't know exactly what's with each bank, but you'll know the range. So you might need to be aware of that. If you are planning on holding large amounts of cash for some reason on your platform, then you need to be aware of your protection when you take into account the cash balances you have elsewhere. The Pension Confident podcast is excited to announce that they'll be recording a live episode on Thursday, the 4th of May at White City Place in London, and they want you to come and join the audience. Host Philippa Lamb will be joined by myself and other guests, including Financial Times consumer editor Claire Barrett, financial expert, author and TV personality Peter Komalafe, and Pension Bee's Director of Public Affairs Becky O'Connor, to discuss if your money's better off in a pension or an ISA. Tickets are completely free. To get yours, visit eventbrite.co.uk and search Pension Bee to take you to the event page. Don't forget, you can also download the Pension Confident podcast wherever you listen to your podcast. So remember, that's the Pension Confident podcast live on the 4th of May at White City Place. I look forward to seeing you there.
Okay, so moving on to the next piece of the podcast then, Damien, you've been doing some research into funds that are exposed to the potential banking crisis. What have we got on this?
Yeah, so I carried out a piece of research for 80/20 investor members a couple of weeks ago now, and it was looking at funds that could be exposed to a banking crisis, and then in turn, if it escalated into a financial crisis. And it's not an easy thing to do, because obviously quite a complex task, because you've got to think about it. Funds can invest in lots of different companies. So you can get an equity fund that may invest in global equities and invest in companies from different countries and different sectors. And obviously with the banking crisis, we had this period of like dominoes almost falling. One bank would come into focus, Deutsche Bank it could be SVB, it could be Credit Suisse. And bank stocks were suddenly being put under extreme pressure, individual ones, but then that would bleed over to other banking stocks around the world. And of course, what was happening is that particular sector was where the problems or the epicenter of all the losses were. And so other sectors were experiencing much smaller losses, or you were actually seeing people go into technology stocks actually, which was quite interesting. But the point is, if you're looking at your portfolio, you might be sitting there thinking, if this really escalates, am I exposed more than average to a banking crisis? So in simple terms, if you had a portfolio that had a lot of banking stocks in it or a lot of exposure to financials, then if that sector completely melted down, then you are going to obviously have bigger losses, or more likely to, than something that had a much broader range of sectors, or let's say less exposure to the banking sector than, say, an average portfolio. Now, how do you go about trying to work out what your portfolio's exposure is, what's good, what's bad? Because you could look at a fund fact sheet and you might sit there and think, God, it has got exposure to banks, but you might not realize that actually it's below the norm for that kind of fund. So actually, it's not got much exposure relative to your alternative choices. So I went through and decided, how would you carry out a piece of research to find out the funds most exposed? Now, I carried out the research. There were heat maps that were published on 80/20 Investor. If you're interested, you could take a free trial that showed the funds that had exposure to certain key banks in America, the UK, and the US. But for somebody who's listened to this podcast, I'm going to explain how you can go about doing this research yourself, and there's a process to follow. So, first of all, if you want to go and look at a fund and say, look, I'm interested in this fund, or you might hold it, how do I know whether this has got some exposure to that banking sector, or if we're going to get a continuation or an escalation in that banking crisis, that this is going to be a fund that is going to pretty much implode or struggle? Now, one way to do that is you need to find a period in the market where the banks struggled the most. So you need to find that point where bank stocks plummeted versus other sectors. So when fear was at its greatest, because with investing, if you find extremes, that's when you can notice the patterns. Because when bank stocks collapse, because let's be honest, bank stocks, a lot of them have fallen between 10 and 20% in a matter of 10 days. That is a very big move. And so that shows up in the performance of funds who might only have some exposure to those stocks. So it's far easier to quickly highlight funds that have exposure to bank stocks by looking how they perform over that period. I'm talking about the funds there, how those funds perform over that same period. Because if there's extreme moves and they're at the bottom of the performance table over that period, you know it's more than likely when you dig deep and open up the fact sheet that they've got exposure to these particular areas of the market. So in this case, banking stocks. Instead of having to go through 2,000 funds and trying to identify individually which funds have exposure by just reading the fund fact sheets. Now, one way to identify the period is to go and look at a broad index. So XLF, if you put XLF or the $ XLF, that is a ETF that tracks the financial stocks in the S&P 500. So it's kind of a quasi benchmark for bank stocks in a way. And if you look at that over the period of March, you will see that it suddenly tanks, it falls. And you will therefore see the extreme period of stress. And it was from the 8th of March to the 20th of March. Straight away, therefore, you know that if you take that period and you apply that period to the fund in question that you might be researching, see how it performs versus its benchmark. And if it massively underperforms during that period, you therefore know it's probably more exposed to that area, i.e. bank stocks, than the average of its peers. And you can compare it with individual funds. Now, the interesting thing is Morningstar actually allows you to draw tables for a fund. So you can go and find a fund you might be interested in or fund in your portfolio, search for it on Morningstar, then you can go to the performance tab. You can then change the date to 8th of March to the 20th of March, and then you can see how that fund has performed versus its benchmark. So you can see and compare it to actually other funds if you wish. You can choose them. You can therefore identify, yes, this fund is one that if this escalates, it's going to struggle. Or, I mean, there are people who might be sitting there thinking that everything was overblown. This might be a value opportunity. I want to get into bank stocks. You could technically find the ones that you would want to buy. It's up to you. It's your research. Now, the problem with just trying to screen funds by bank stocks, so maybe people listening go, can't I just screen by bank stocks, see the percentage exposure? The trouble is most platforms don't allow you in them, and I haven't really found anywhere that research-wise that can allow you to do it. What they tend to do is say financial stocks. You can find a fund's exposure to financials, but financials includes bank stocks, but it also includes other non-banks. So it could be maybe some insurance companies, things like that. So just because something's got a high financial exposure, it doesn't mean that it's actually got exposure to individual banks, but it is a useful starting point, because if something has a high financial exposure, then it probably does have quite a few banks in its top 10 holdings. So what I want to do is also give people some rough numbers. So if you pick a fund from the European sector, so if you've got a European fund in your portfolio, I went and analysed every fund out there for those that have hardly any exposure to those that have lots. The average financial exposure is 16.22% of assets. So 16% of the assets of a typical European equity fund, I'm only talking about equity funds in this piece of research, are exposed to financials. So if you look at a fund and it's more than that, then you know that's above average. If it's below that, you know therefore, oh, actually this is underweight, they would say, financial stocks, and it's possibly underweight bank stocks too. Global funds, the average is 14.4% exposure to financials. Global equity income is 19.71, quite a bit higher. And that tells you something else which is interesting from this piece of research, that income funds will tend to have a higher exposure to bank stocks, and that's because they can be good dividend payers. So if you don't want exposure to bank stocks, or you have equity income funds in your portfolio, that's probably where the problems lie. And that is true of my own 50k portfolio. The funds that were equity or the global equity income funds, that's where the highest exposure to financials exists within my own portfolio. Japanese stocks is only 12.2%. North American equities, it's 11.73%. Now that's probably because a lot of North American equities will be exposed to the technology and growth sectors. UK all companies is 18.94%. So think of those as UK equity income funds, has a high bank exposure. FTSE 100 is a high exposure to bank stocks and things like oil and gas than technology. There's very little technology exposure, whereas in America, the opposite is true. And so that's why during the period, you would have noticed that American equities held up better than the FTSE 100. So you've seen the S&P 500 do okay during this banking crisis versus the FTSE 100. UK equity income funds is 24% exposure to financial stocks. So almost a quarter of the funds are exposed to financials, and therefore if you look at the numbers, probably a significant portion of that is being exposed to individual banks. You'd have to go and look at the fund fact sheets to find out which individual banks are exposed, or like I said, I did a heat map on the 80/20 investor research sector. So from this piece, if you are worried about a banking crisis, you should be able to look at any fund that you can find and look at its performance between the 8th of March and 20th of March. That will give you a very quick, dirty, right, this is more exposed probably than its peer group average. You could compare funds and then look at their fact sheets and go, right, yep, this does have less exposure than normal. Another way is those financial stocks, which includes banks as a subset. I've given you some numbers there where you can look at a fund fact sheet, because they will all tell you the sectors they're exposed to, and quickly look at it and go, is it above or below the numbers that Damien just mentioned? Then that gives you, again, an idea if they're overweight or underweight. So hopefully I've given people some insights there that they can take away if they want to start doing some of their own research about banking stocks and banking crisis. And just a final point, XLF that I mentioned earlier on, that index that you can use, that ETF, it's also very useful in trying to get a broad measure of what's going on with the banking world. Are we still in panic mode? Now, if you go and look at it, you would have seen that the XLF has a number, obviously it's an index, and just before the banking crisis started, it was on 36, okay? Well, it then plummeted within days down to a level of 31.63. So you can look at that line and you can see the stress. So if the line is recovering and moving higher, you know the concerns about the banking crisis are abating. So it's quite a good measure of, is there still concern out there? Now, if you look at that line, after that crash on the 8th of March, really where we've got to from the 20th, we're kind of bouncing along. So it's not fully recovered at all. It's kind of just bouncing along. It almost feels like the world is just pausing for breath at the moment and thinking that things haven't escalated in a period of calm. But the reason I mention it, look at the number 31. That has been a level that index has been bouncing along, and it hasn't really broken below it. And that 31 level is crucial, because if you go and zoom out, if you're looking at that chart, go into Yahoo Finance, put XLF, you can chart it over a period going back years. You will see that that was actually that 31 level from a technical analysis perspective was a support line that goes back to October last year, July last year. If you go back even further, it marked the top of the market at the pandemic, and it also marked the top of the market going back to the financial crisis. The point is, if we break below 31 on that level, then that shows you there's real concern in the banking sector, and that will therefore likely bleed over into other areas of obviously the economy and other sectors as well. So it's probably one of the graphs that I'm watching at the moment. As long as we're above 31, then we can sort of sleep at night. If we get below 31 and it starts to unravel, well, it could unravel quite quickly, then that will be a concern. So something, if you're not into investing and you're thinking, what's going on with the banking sector now or the banking crisis, just look at that number. 31 is the important level.
Okay, so let's move on to the final piece then, and we're going to be talking about maternity leave and remortgaging. So Damien, elaborate on this. Why are we covering it in this week's show?
So we've been saying that we're going to do much more content that is focused around life events, but particularly for our female audience. And it isn't just focused for our female audience as well, because don't forget, obviously, if you're starting a family, people will be sharing their finances. I remember going back to when we started a family, my wife and I, that we were looking at our finances in the lead up to having a baby and then thinking about things like remortgaging and our bills and trying to plan. Now, there are people out there who either may be pregnant now or plan to have a family or maybe on maternity leave, and they may be one of the millions of people who might be trying to remortgage in the next year or so, and they're panicking because they're thinking, obviously my earnings are going to plummet. How's that going to impact the ability to remortgage? It could be that your partner is about to have a baby and you're sitting there thinking, what's going to be the impact for us? So what I want to do is play out a piece of audio. So this was, again, part of the Habito thing that we did. We got Habito in. A bit of it was played last week, but this is Lauren. Lauren did some Q&A around some of the basics to do with remortgaging rather than specific listener questions. And this is the bit that relates to maternity and pregnancy. So this is whether you are remortgaging or if you're taking out a mortgage, what the impact is. So let's play the audio.
If you're currently on maternity leave and you are due to remortgage, will that affect you throughout the remortgaging application?
So generally, maternity leave won't be a problem. It does depend on your return to work terms, though, with your employer and what anticipated childcare costs will be as well. So that's important, as a lot of people do forget that to include on applications. So lenders will ask when you do return to work what those costs will be. So lenders will ask for you to provide a return to work letter confirming what your salary is going to be and or evidence of your pre-maternity income. Now, a broker will be able to factor this in when you come to remortgage and compare what other lenders can offer, again, versus a product transfer.
So if you are remortgaging and you are on maternity leave, is it better to do a product transfer rather than remortgage to a new lender?
Not necessarily, depending on what rates are available. Naturally, with a product transfer, there's going to be less paperwork as you're sticking with that current lender. However, if your current lender is offering a lot higher rate, it's going to be a lot of the time worth asking your employer for that return to work letter or asking for your pre-maternity pay slips to actually secure that better deal with another lender, as it will save you a lot of money in the long run potentially.
On that, do you have to tell your lender that you are pregnant?
Yes, so you do need to disclose this on the mortgage application, and your future child will be included as dependents as well as the future childcare costs. It's important that you fully disclose this and the whole accurate picture of your circumstances. So if this was to come to light further on down the line that he hadn't disclosed it, a lender could withdraw their offer, or you could end up with a mortgage that you may not be able to afford in the future, which could lead to financial difficulties.
Yeah, that's great. Thank you. So if you do have any more queries or questions about remortgaging when on maternity leave, we do have an article and a guide on the Money to the Masses website, which has more information on that for you.
So one thing to point out is that obviously if you take short-term paternity leave, that's unlikely to affect your mortgage application at all. But obviously if you take longer paternity leave, then it's going to be a similar scenario. We need to obviously let lenders know. Now, one thing I want to pull out of that piece that Lauren did with Habito is that the idea of a product transfer. So a product transfer is effectively where you, with your same lender, you change products. You're not increasing your borrowing, you're not changing the term, you're deciding to have a like-for-like switch of products. So if you had a 2-year fix, you might decide to change your mortgage product to something else and maybe another fixed term product, and effectively the rates changing. And the reason I want to highlight this, because I spoke to Habito and checked this all through with them, is because if you are planning on having a child, one thing you have got in your arsenal is that you always have the ability to do a product transfer. So if your earnings drop or you are pregnant, you don't have to disclose these things to them if you are going to do a simple product transfer. You're not changing how much you're borrowing, you're not changing the term. And so they won't ask you, and you don't have to disclose it. And so that means that even if you are going to have a drop in earnings, you will always have the option of a product transfer. You won't be stuck on your existing mortgage and have to go on to the really high standard variable rate that they will charge, the SVR. So at the moment, those SVRs are incredibly high. You will have an option of doing a product transfer. Yes, you probably won't get the best rate in the market. That is unlikely unless you're just lucky that your lender is the top of the best buy tables. So it's not ideal, and you want to have many options as you can open, which is why the piece that Lauren did explained about what you need to do in terms of having evidence about your earnings before and after maternity, because then you can remortgage and get the best deal. But the part of this podcast was really to give people who are in this scenario the knowledge that there are options still open to you, even if you are planning on having a family. So hopefully that's good news to some people, and it might take a bit of stress off them. But like all these things, you've got to plan ahead.
Okay, so there we go. I'm sure a lot of listeners will find that particularly interesting. So if you have any particular questions that you'd like us to find out that you think, I'm not sure I know the answer to that, and you've struggled to find the answer, we have the ability to be able to ask the experts, and it will always, I'm sure, make an interesting piece for the podcast. So do get in touch with me, Andy at moneytothemasses.com, or Damien at moneytothemasses.com. Now, we're nearly done for this week, Damien. One thing to quickly mention before we go is that we are going to be taking a break for a week. I'm sure listeners won't mind. There's been lots going out on the feed, including the Grow It series, but we've got families, it's Easter, and so we're going to have a 1 week break, but then we'll be back fresh after the new tax year, and we'll be raring to go with loads more content.
Yes, so there is some really interesting, exciting content coming up actually after our break, and some of that links quite nicely to the last piece on the podcast where it's centered around life events, and it will really be helpful to not just our female listeners but also our whole audience. But it's something that we've promised that we would look into and do more on, and I think I'm really excited about it, and so are the team. So that means that there's not much else to do this week other than say the usual: join the Facebook group, facebook.com/groups/money to the masses. Leave us a glowing review on whatever podcast app that you use, and make sure to follow and engage with us on our social channels, particularly Instagram, where I spend a lot of my time. And that just leaves me to say, as usual, Andy, until next time.
Until next time.